Interactive brokers. A Wide-Moat electronic broker, priced for perfection. Overall verdict, yellow. Watch not chase. Interactive Brokers was founded in 1977 by Thomas Peterfy and is headquartered at 1 Pickwick Plaza in Greenwich, Connecticut. It's an automated electronic broker, offering trading, clearing and custody across roughly 150 markets worldwide. The capital efficiency here is extraordinary. Just 3,182 employees. Support $6.2 billion of net revenue. The public company owns only a minority interest in the operating business. The rest is held by founder Thomas Peterfy's holding entity. Milan Galic has been CEO since October 2019, an internal veteran, who built much of the trading technology himself. Price versus intrinsic value. Current price, $87.99. DCF base case, approximately $73 per share. That's roughly a 20% premium, no margin of safety at today's price. P/E ratio, about 40 times trailing earnings, meaningfully above this company's entire 7-year historical range. The bull case, if the current hypergrowth persists, is $150. The bear case, if growth normalizes and rates compress margins, is $36. 4 numbers define interactive brokers. ROIC, 17.5% in 2025. Revenue compound growth, 21.4% over 7 years. Net margin, 15.9%, the highest in 7 years. And pretax margin, 76.9%, the 7th straight quarter above 70%. Phase 1 forensic screen. 3 of 8 signals triggered, and all 3 are fully explained. The most important one is a data problem, not a company problem. Our standardized data vendor reports interactive brokers' revenue on a gross basis, before netting the interest paid to fund client balances. That understates pretax margin as roughly 47%, when the company's own reported figure is 77%. We corrected every ratio in this analysis using net revenue. The other flags are just as benign. A disclosed ownership structure effect, and a pattern of small regulatory fines, immaterial, worth watching, not alarming. Phase 2 financial analysis. Net revenue grew from under $2 billion to $6.2 billion, a 21.4% compound annual growth rate, entirely organic. Client accounts, client equity, and daily trading volume are all growing. 30 to 40% year over year. This is real usage, not acquisitions. Margin trend for broker means pretax margin, not gross margin. 59.7% in 2019, climbing to 76.9% in 2025. Net margin followed the same arc, 8.3% to 15.9%. Every single year of expansion, with only a brief dip in 2020. When near-zero interest rates compressed the spread on client cash. DuPont decomposition needs a big caveat here. Asset turnover and leverage. Look extreme for a broker-dealer, because the balance sheet is client custody assets, not company risk. What matters is the margin lever. Return on equity improved from 11% to 18.3%, driven almost entirely by margin expansion. Leverage actually declined for most of the period. Phase 3 moat assessment. 7 of 9 10-minute test filters pass. Verdict Wide-Moat. The evidence, a 77% pretax margin, sustained for 7 straight quarters, with just 3,000 employees running a $200 billion balance sheet. That is a genuine, structural cost advantage, not achievable without decades of proprietary technology investment. And it passed a real stress test. The 2020 rate shock compressed margins, but the franchise recovered and compounded to new highs. Phase 4 capital allocation, verdict green. This doesn't look like a typical buyback story. The real mechanism is structural. The public company's ownership share of the operating business has risen from 18.5% to 25.8% since 2019. designed to be value neutral per share while growing the public claim. On a compounding business, no material acquisitions in 7 years, growth has been entirely organic. Phase 5 Competitive Dynamics, Verdict Wide. Real-scale economies, a genuine cornered resource in global regulatory licensing, and strong process power all stacked together here. The clearest evidence of durability right now, Chinese regulatory turmoil. At competitors Tiger and Futu is driving a clear uptick in account transfers. To interactive brokers, a competitor's weakness becoming this company's growth. Overall verdict, yellow. Watch not chase. Interactive Brokers is one of the highest quality businesses in this coverage series. A wide moat, margin expansion every year for 7 years. EPS growth every year with 0 exceptions. And disciplined, shareholder-favorable capital allocation. The complication is entirely valuation. Today's price already assumes the current hypergrowth persists, rather than merely moderating to a still excellent pace. A real pullback into the $55 to $65 range would restore a reasonable margin of safety on a genuinely excellent business. 10-minute quality test, 9 filters. Ever profitable, pass all 7 years, margin rising every year. Consistent EPS, pass grew every single year, no exceptions. Clean balance sheet, not applicable client custody structure, not company risk. 7 of 9 pass, one of the cleanest results in this entire coverage series. Share count, 307 million in 2019, 448 million today. That looks like dilution, but it isn't, it's mechanically tied to the public company's rising ownership share of the operating business. Cash buybacks are modest here, $17 to $84 million a year. They are not the primary capital return lever. The real lever is the ownership share mechanism itself, structured to be value neutral rather than timed like a traditional buyback. Debt to equity is effectively 0 throughout. Interactive Brokers carries almost no true corporate debt. The balance sheet's apparent size is entirely client custody structure, not borrowed capital funding the business. 3 valuation methods, all pointing the same direction. P/E ratio, about 40 times, well above the 7-year historical range. DCF base case, $73 per share at a 9.5% discount rate. Bull case $150, bear case $36. For a wide moat compounder, fair value to buy is around $55 to $58. Today's price offers none of that margin of safety.